Hi, thanks everybody for logging in to Property Method live training for Module 5. Today we have Dr. Ong KL and me KC Lau. We are both from Property Method, and today topics is about Module 5, how to choose the right form of real estate ownership. So I'll let Dr. Ong to lead this session.
Okay, thanks Casey. Hi everybody, welcome to Module 5 of Property Method, how to choose the right form of real estate ownership. In the previous module, we discussed some different types of properties, and we know that apartments is the best place to start with because of its unique advantages such as regular income, affordability, market demand, and resistance against negative business cycle. Until now, all of our discussion concerning the purchase of a real estate investment has been based on individual ownership. This is probably the most common form of investing in real estate. Most people are familiar with individual ownership because they already own a home. But there are other methods to own a real estate investment. In this module, we will cover some of the common types and discuss the pros and cons of each other. So why is it so important to know different types of ownership in real estate investment? Well, because we need to choose the right form of ownership to start with. And when situations change along the way, we will know the best option for us to change the form of ownership. So before venturing into any of these forms of ownership, we should always seek professional advice, as we always recommend. Always seek professional advice to determine which method may be the best for us. And we have to highlight here again that tax and legal complications are not covered in this module. Okay, so let's look at the first common type of real estate ownership, partnership. Most of the time, two or more investors will join together and form a partnership to buy property. They will each invest a sum of money and share proportionately in the return produced by the investment. So this allows an average investor the opportunity to be owner of a larger property or more properties than he could have purchased by himself. A very common drawback of a partnership is that there are always disagreements between partners. For example, partner tends to have a disagreement as to the operations of the property. One partner may feel she's doing all the work in maintaining the building, or one feels the building needs painting and the other doesn't feel they should spend that money. One way to avoid these unpleasant situations is to find a partner who will allow us to buy controlling interest, which is over 50% of the investment. So our agreement should allow her to sell her partnership interest at the current market value if she wants to be out of the partnership. We will also want partnership agreement to give us the first right of refusal to purchase her share at whatever price she was able to obtain from an outside investor. The meaning of the first right of refusal is that partner A or investor A can only sell to other party after partner B refuses to buy up the share of partner A. So this will protect the interests of both partners if any one of them want to be out of the partnership. Some partnership works very well, but some of those fire sale properties are found in the market commonly have been a result of partnership disagreement. So it is not possible to itemize every possible area for disagreement and how it is to be resolved. All partners must have good faith would trust between themselves in order to venture into this form of ownership. So we should only enter into a partnership with someone whom we can trust and work well with. Okay, second type of ownership, we're going to discuss corporate ownership. A private corporation is relatively easy to set up in Malaysia, but it is more than what we think. A simple private corporation or Senjang Berhad is usable as an investment vehicle, normally known as a private limited property holding company with at least 2 shareholders. In Malaysia, a company is automatically considered as an property investment holding company if more than 80% of the company's income is rental income or income generated from investment properties that it holds. Regardless of how many properties a company owns, if more than 80% of company's income is from the rental income. So in Malaysia, if more than 80% of company's income is from rental income or income generated from investment property, then it will be regarded as an investment holding company. There are several advantages to buy properties under a company. One of the biggest advantages most people may think of is the tax benefit. In fact, tax advantage of a company is only significant if our personal income tax bracket is already exceeding 20%, which is I think right now is ringgit 70,000 ringgit for annual chargeable income. Then you will hit that 20% personal income tax bracket. So this is because corporate tax is a flat rate of 20% for annual profit below 500,000 ringgit. So only when our personal income tax bracket is beyond that, above 20%, then the company, this corporate ownership will give us a tax advantage, but provided annual profits is below 500,000 ringgit. Other tax benefits of a company include like more deductibles than personals, such as staff payroll, depreciation, or other operating expenses like office expenses. Okay, for rental income of a company can only be treated as business income in Malaysia if maintenance services or support services are comprehensively and actively provided in relation to the real property by the company. Otherwise, the rental income is not subject to those deductibles that we mentioned in the previous slide. You can always refer to the public ruling of income from letting of real property, which I think we have a download link in the page of this module. And also, one more thing to be careful here for investment holding company. Allowable deductibles for investment holding company are much lesser than a normal company, a normal Senjang Berhad. Only 25% of the total operating expenses is deductible, and this amount should not exceed 5% of the total rental income. This is the reason why investment holding company is excluded from non-business rental income source in the section 5 of the public ruling. So you please download the public ruling and carefully read all the clause involving all these property investment company.
So in this case, what we found out is that it might not save as much tax as you imagine, right? So most people will think, oh, I've owned many properties, I should set up investment holding properties for the tax saving purposes, but due to this ruling, probably you won't save much, right?
Yeah, the government is very clever. They don't want to create a loophole for people to park all the rental income under company and evade the tax. So that's why they have this cap of so-called maximum 5% of total rental income deductibles.
And this thing also keep changing because whenever we find a loophole, they will impose something because apparently they know that you are try to evade tax.
So it's better that we keep up to date the information from our so-called professional team, like our
Tax planner.
tax consultant, tax advisors.
Mm.
Okay. Another advantage of a company is that it allows foreign investors to act as directors of the company, to invest in properties priced below 1 million through the company in this day. So foreign investor who want to buy properties in Malaysia with individual ownership can only purchase properties priced above 1 million now. I think
Yeah.
for Penang landed properties is 2 million ringgit. With effect of I think with effect of 1st of May 2014 this year. And they have to pay a state levy of 2 to 3% for each property. So I think, as I know,
Anyway,
for
wise,
Johor is
the slide is not changed, right? It still show 500k in the slides.
yes. Sorry, it's not up to date yet. Okay.
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 Can we do it now? Like, can we just change it right now? Yeah.
Just change it now. It
Yeah.
should be.
And then I think the only place that is not subject to this is Medini in Johor, Iskandar, right?
Yeah.
I think they can buy any property, even like it's priced 300,000 or 200,000. You can foreign investors still can buy it in Medini.
For that,
You
for
can
the
find this
special
one.
zone, yes.
Yeah.
So, in this case, if we are getting our startup capital from foreign investors or some foreign partners, so this kind of arrangement of setting up an investment holding company might work for us to so-called invest together with all these foreign investors. But of course, all these so-called conditions, terms and conditions, we have to take into consideration as a part of the cost. Okay.
Dr. Ong,
And,
can you explain for the layman what is levy?
Okay, the levy, the state levy is imposed by different states. For example, Johor state government, they will charge the 2% this day. I think with effect of 1st of May 2014. Last time they will just charge 10,000 for flat, yes. Now,
Yeah.
but for this day, because the minimum price is 1 million already for foreigner, while now they will revise from 10,000 K to become 2% of the purchase price. So in this case, the 10,000 no longer valid, because for a foreigner, the minimum have to buy 1 million. And 2% of 1 million will be minimum 20,000.
20,000.
Yeah, so I think maybe I need to change here also. So no more 10,000 state levy, so minimum will be 20,000.
Okay.
And from what I understand, Penang they are revising to 3%, even higher for the state levy, 3% of the purchase property price. So this will be an additional cost for an investment holding company, for foreign investor to acquire property using individual ownership. So it's a kind of motivation. It's a kind of motivation for those foreign investors to set up an investment holding company in order to so-called save this 2 to 3% of the state levy.
So in this kind of corporate ownership, that means one of the shareholder can be a foreigner, right? So the foreigner cannot be a major shareholder, is it?
Yes.
So that's the condition, is it?
Yes, the condition is a major shareholder must be local, must be residents in Malaysia.
Okay. So like 49, 51, then it's okay. 51% local,
Yes,
49%
yes.
foreign.
51 and 49, yes. Okay.
Good.
Then let's proceed to the next slide. The drawback. A significant drawback to invest in real estate through a company is that we have to pay extra costs to maintain. Although they have this form has the advantages that like we discussed in the previous slide. The extra cost to maintain the company like secretarial and audit fee. So in this day, I think a minimum cost of minimum 2,000 to 3,000 per year is required if yearly transaction of the company are not many. And extra procedures of extra effort are also required in terms of management, bookkeeping, preparation of a resolution for every acquisition of a property, and for the authorizations to bid auction properties.
Mm.
We may also face difficulty to take up mortgages from banks when our company is still young, for example, less than 2 years. And normally banks will offer higher interest rate, for example, 0.5 to 1% higher than a personal mortgage, and also a shorter tenure. Normally, I think below 25 or below 20 years, depend on banks. So for corporate mortgages, the terms are more not to the favor of investment. All these have to be taken into consideration if you want to acquire properties through a company. Unless we plan to grow our company into a larger scale of property holding, investing through individual ownership is still considered more viable in the beginning until we hit higher personal income tax bracket, as we discussed before, or the maximum limit of personal credit allowed by banks. Then we may want to consider using corporate to leverage, because normally a company, the financial credit allowed by banks will be higher than personal. In fact, the biggest advantage of buying properties through a company is the limited liability provided to protect our assets, especially if our investments or assets are shared among more than one individuals. So let's go into more details of corporate ownership, the management of a limited liability property holding company. When a group of investors is formed to purchase a specific or a group of properties through a company, each contributes what he wishes toward the purchase, usually in a easy to divide shares, such as 10% each for 10 shareholders. One of the members of the group, or even an outsider, has to be selected to become the manager for the group and for the investment. He's given all the decision-making power for the investment. So this includes management, although he may hire a professional management company rather than handle it himself. And everything that happens to the investment is at his sole discretion. He decides when major expenditures are needed, but we usually attempt to get a group opinion first. And he determines the optimum time to sell or to trade and establish the selling price also. So this is to make the management of a so-called group in a company, a group of shareholders, to make the so-called decision-making process easier, instead of every time have to ask the opinion from every single shareholder. And it is obvious that this manager must keep the goals of the group in mind at all times. As a manager, he also assumes total liability for the investment. And the group is, of course, the group is free to replace the manager if they are unhappy with him. The remaining shareholders in the company are limited shareholders. Their financial obligation is limited only to their initial investment for a property or for investment. If the whole investment goes bad, the most they stand to lose is only their initial investment on that particular investment. So why would anyone want to be the manager in this kind of company? So first of all, if a property is properly selected and managed, then it is not very likely it will become a bad investment. So the manager is usually paid for his services. On top, and most of the time he also has a share in the company. So it is in his best interest to make that investment profitable. And we come to selling so-called our share in this kind of company. A shareholder decides he no longer wishes to retain his share in the company, and he will be free to seek a buyer for it. Selling a portion of a company share in a real estate holding company is not much different from selling the property itself. The seller offers his portion to potential investor at what he considers to be a fair market value. This will no doubt be a price higher than he originally paid. Because it's still considered a real estate investment that's appreciating every year. The only difference is that it may only represent a 10% interest in the entire project instead of 100% ownership. So once a shareholder has got a ready buyer to purchase his share at a certain price, the other shareholders will generally have a first right of refusal, just like the partnership, to buy over that share on the same terms and conditions as the offer that he can get from outside. So these terms of first right of refusal also apply in a corporate form of ownership.
Mm-hmm.
Before we go to the next form of ownership in real estate, there are some cautions to be aware of for corporate ownership here. First, all members of the company should have the same basic investment goals, and investors who is looking for cash flow should not be put with investors who wants fast cash from trading or from flipping with little or no cash flow produced by the properties. Because obviously one property cannot offer both cash flow and also fast appreciation or fast money generated from fast trading.
Mm-hmm.
The second cautions, we have to select a knowledgeable individual to act as the manager, who are so-called the main decision maker in terms of all the investment. You should also have this manager should also have a share interest in the venture so that his profits is tied to the success of the investment. The third cautions, we have to determine the guidelines as to the operations of the properties at the time the company is founded. So this include the basic management policies, optimum holding period, and so etc. Using this vehicle, investors with limited investment capital are able to join with others and share proportionally in the profits and tax benefits offered by real estate investments. Without the company, many would not have sufficient capital to become a real estate investor. At the same time, since control is in the hands of the manager, disagreements among shareholders are so-called minimized or eliminated. However, we still have to think and calculate carefully based on our investment plan in order to evaluate if it is worth it for us to invest in a real estate through a company.
Yeah.
And again, before we venture into any form, we should always seek professional advice on tax and legal complication. Okay, in year 2012, end of year 2012, a new form of investment vehicle was approved in Malaysia, called Limited Liability Partnership, or LLP. LLP is a combination of a partnership and a private limited company. It enjoys the same benefits of a private limited company, like the limited liability among shareholders, corporate tax, and the same deductibles also for just like Sdn Bhd. It also provides extra flexibility, such as there's no limit on the number of partners compared to Sdn Bhd, and audit on financial statement is not compulsory, so that may save some cost and also provide the flexibility in terms of preparing the financial statement. However, because it is a very new form of entity, and that's why it can be quite challenging in securing a loan from banks. So it is more suitable for those investors who do not need bank loan to buy properties, to have this kind of a limited liability partnership in order to take the advantage of extra flexibility, and also still have a limited liability for all the investment. And in fact, this form of entity is not new in overseas. Like for example, Singapore and even US. This form of entity is more popular for those professional firms like law firm, accounting firm, audit firm, or even consultancy firms, where protections of partners by limited liabilities is important, but at the same time the flexibility is required to operate this kind of firms, professional firms.
Yeah.
Okay. The last form of ownership in real estate that we're going to discuss is real estate investment trust or REITs. A real estate investment trust or REITs is a corporation investing in real estate that reduces or eliminates corporate income taxes. Each year, a REIT is required to distribute 90% of its profit or more to the shareholders. So this is one of the criteria to establish a real estate investment trust. By doing so, the trust will not be subject to corporate tax, to any taxation. Only those individuals who receive shareholder profits will subject to individual tax. Like other corporations, REIT can be publicly or privately held. Public REITs may be listed on a public stock exchange like the shares of common stock in other firms. The REIT structure was designed to provide a similar structure for investment in real estate as mutual funds provide for investment in stocks. By buying stocks, of course, like buying stocks also, we have no control at all in the operation or selection of the investment property through some REITs. Although some REITs they specialize in a specific type of investment property, such as some may specialize in a shopping mall. For example, I think in Malaysia these are IGB REITs. Some may be specialized in offices like just like UOA REITs. Some may be specialized in industrial buildings like Atrium, and residential like Sunway REITs. So compared to stock, shareholders of REITs at least have the opportunity of checking the physical properties or the projects held by the REITs. But we still have no control over the management or operations of the property. So we can't enjoy other advantages that we discussed, like in Module 1, advantages of real estate investment come with the full control of property ownership, such as leverage through finance. On the other hand, of course, investing in REITs gives us peace of mind about managing our investment because we don't manage at all. Okay. Here, the only key performance that we have to monitor, the key performance data to look at for a REIT. This NAV, net assets value, AFFO or adjusted funds from the operations, and CAD, cash available for distribution. So these three are the key statistics that we have to monitor for the performance of individual REITs. Well, some REITs ran into financial difficulties during the time of recession in history. It was due to incompetent management of trust. They venture into real estate investment without adequate knowledge of selecting or operating the investment they acquire. So unfortunately, the REITs that were mismanaged gave all the REITs a bad name at the point of time. But however, this day, there are some reputable REITs in the market already. And most of them have so-called tied in with real estate professionals teams. So this overcomes their initial management error and turn REITs one of the so-called convenient and easy form of investment in real estate. So why we consider group investments and miss the fun? Okay, as shown in the title of this slide. Okay, there are two primary reasons for considering any group form of investing that has been discussed in the previous slide. First of all, it offers an investor with limited investment capital while getting involved in the opportunity of real estate investment, because not everybody has enough capital to acquire a big real estate investment or a big project. So using all this kind of group investment vehicle, an investor is able to join forces with other investors and pool resources. These groups, as it was pointed out, can be anything from a single partner to a huge or even national scale of real estate investment trust. In the larger ones, the investor loses the individual identity, lost no control at all, and probably does not even know where his funds are being invested. But anyway, if you had bought shares of the previous Star Hill REIT, or now they call it YTL Hospitality REIT, listed on Bursa Malaysia, we still can walk into a Star Hill Gallery and show our friends that we bought part of this mall that give us a dividend every year. And, the second reason for investor to join one of the so-called larger groups or those forms of groups of investment vehicle is to completely divorce themselves, make themselves aware from the task of locating, the task of analyzing, the task of purchasing, and even to manage our real estate investment. The group we've joined does all of that task for us. So we just leave it to manager, or we leave it to those active partners, or even leave it to professional management teams to run all the show. So we are more like a passive investor if we invest in group. So, and we hand our money to someone else and see if they can produce better return for us. Of course, when we do that, there will be extra costs also in the middle of the process in the form of like management fees, trustee fees, etc. Well, however, our recommendation is to make every effort to go it on our own, because if we did not want to become personally involved, actively involved in real estate investing, why are we studying this course? Why are we learning this module? Okay, now we let's summarize. We realize that there are several forms of to own real estate, and we can purchase a property as an individual owner, through partnership, through a private limited company, or investment holding company, and also REITs and the latest form LLP. I think I need to update this slide also. LLP is not included here. It's a combination of it's a very new form. Yeah, it's under corporate with the flexibility of partnership. So at the beginning, we should start off with buying property as an individual investor, as we always recommend. When our investment capital is limited, then we try some of the techniques that were outlined in Module 3, how to source for capital. Whatever way we have to start, our financial rewards will be greater if we own and manage our own property compared to group investment. It also gives us a feeling of satisfaction to know that we are an real investor in real estate, and that we did it on our own. So use this brief module as a basic background on the types of investment ownership that are available to us. We may need it in future for those some purposes. And always remember, before venturing into any form of this ownership, always consult our legal advisor and also tax advisor. Okay, that's all for this module. So members are encouraged to post any question or comments related to this module. In the next module, we will talk about how to spot investment grade properties. So there will be a so-called the beginning of the excitement of real estate investment process. Yeah, we will discuss how to locate cheap properties, and we'll discuss how important is location for property, a good property, and also the property details to check before we put our money down. So that's all for the content of Module 5. Casey?
Okay, great. Thank you, Dr. Ong. So I guess we don't have any technical question here, and I think as we have mentioned before, just to recap, the first choice to go to is it is better to buy the property outright on yourself. So find whatever financing you can, and
Yes.
we also show you, Dr. Ong also show you in your module 3 where you can
How
know there are different sources of capital that you
capital.
can do financing on your own. So that is the first choice we always recommend. So buy it on your own name, and when really you hit the maximum financing capability you can, then maybe you can look into this partnership or corporate. And when it comes to, I think when it's a point that you come to have to own properties using corporate, we probably have a lot of properties, and you are going to employ like full-time staff just to manage all those portfolio. Then you can really consider whether you should go
Yes,
into
yes.
corporate or not, right? Or in another situation is I know that Dr. Ong, you have a partner who is overseas, who is from overseas.
Investors.
She's a
Yeah.
investors from is a foreign investor. So she basically team up with you, and you will also invest through a corporate setup, right?
Yes, to
So
enjoy the
that's
benefit of
to enjoy the benefit of
so
owning property that is below
yeah.
1 million. Yeah.
Yeah, the reason why we always encourage the investor to start through individual ownership is because only through individual ownership, when we are actively involved, then we are able to acquire the knowledge, experience of so-called the entire real estate investment process. And all these knowledge are so-called crucial for us to ultimately successfully achieve our investment goal. Be it in future what kind of form that we're going to take of the ownership. Okay, but the basic knowledge is still there. So only when we are so-called individually involved, then we have the chance to experience and also to acquire those knowledge. If we just leave it to the partner, or just leave it to the manager of a company to run, if you don't have those experience and knowledge, I don't think we are able to trust people also, or even able to give any instruction to the manager, or even to give any so-called opinion and solution if they have come to any problems along the way. So that's my always my advice. So once we have gained all
it's
this,
best to go through that now, go through doing it all yourself first.
yeah, and you can enjoy I think we always said you can enjoy the scene, you can enjoy the people that you encounter, the story that you hear, and also other satisfactions along the way of investment, which I think we don't expect it to come from this kind of experience or this kind of satisfaction from other type of investment. For example, if you invest in the stock, you can maybe just stare at a monitor. While when you invest in real estate, you have a chance to go out and take a look of property, of houses, or even apartments, or even different areas of interest.
Yep, definitely agree with you. So thanks for the great time. So we will schedule the next live training for module 6. So see you all
Okay.
next time. Goodbye.
Okay, thank you. See you.